Okay, one more time to try to explain the differences when we get to loans payable in the consolidation process. We already are familiar with where if we have an asset and its book value is, let's say, 100, but the fair market value is 120, we take that, we paid an extra 20, and for the consolidation, we're going to amortize that over the number of years, if there is a known number of years. We take that differential. Could be that the book value is that and the fair value is this, and so while this increases, say, depreciation, amortization, this time over that same number of years, if this is the circumstances, here we increase and here we decrease depreciation, amortization, if there is a known number of years. We've been through this, we're familiar with it. Situation which gets a little more complicated is with loans. If the subsidiary S is selling a loan because they're selling their business with the loan, the buyer is buying it with the loan, and when we buy stock, the way these problems work for consolidation is we buy the stock and the subsidiary stays as a separate legal entity, so the loan comes along with it automatically, and therefore we are sort of assuming the loan when we buy the stock of the subsidiary. If the loan was taken out at a time of low interest rates, low rates, it means today for the same terms that they're paying, same payment, that's the P on those calculators that do amortization schedules or calculations of interest or periods. It's the same number of months, it's the same interest rate that they've got, and so this is the payment. So the present value, meaning the amount we could have borrowed on these terms that the subsidiary has, is a lower amount than what the subsidiary shows. That means we have to pay the subsidiary when we buy. We've got to pay them for the fact that they had this favorable loan. So it increases the price. If it increases the price when there's a low rate, we're paying for it. So let's say everything else is, let's say all they had is cash and a nice loan, and we want to buy their stock. They might say to us, okay, the price includes paying for the good terms on the loan that we have, which you can't get today. So we might be paying, let's say, $60 for the loan in our purchase price. Or better yet, let's do it this way. Let's do it. We might pay $40 in our purchase price for the loan. We might pay $40 for the purchase price of the loan. So that's the increase of the fair market value of the loan because of the fact that their interest rates are now higher than they were back then when the subsidiary first took the loan. So how does this translate in terms of our problems? How does it work? At that point, what we would be saying is, all right, you're going to have a differential between the book value and the purchase price. I don't know what I was writing here, so let's go back and write it in English. We're going to have a differential, we'll call it DIFF, and we're already familiar with what we're doing here. We're going to look at the fair market value or the price paid versus the book value, and we'll come up with a difference. In this case, if we actually are paying for the value of a good loan terms that they have, we're going to pay them for it. So we'll pay them, let's say, $40. And for argument's sake, let's say that's the only thing we have to pay. That's the full value of their company, just the fact that they got this good loan. So we pay them $40. Our debit to the investment account would be, let's say, $40. Investment account. And let's say that the book value of the subsidiary is 0. The book value is 0. And that means our differential is $40. It's all attributed to the fact that this loan is on favorable terms, better terms than we could get today. And that's the price we paid for the loan. So now when you go to do your adjustments, you see that, well, hey, we paid this. We paid this much. So what we're going to be doing is looking at, this is our original entry, cash, went to the investment account. an extreme example that they only had a loan that we had to pay for, but it was favorable terms, and things can happen like this. But this will help illustrate. Now, when we go to do the consolidation, let's take these facts and go to the consolidation worksheet. So the consolidation worksheet would be parent, sub, the adjustments, then consolidation, and we have a whole bunch of things that don't add up to much, and then we've got this loan line, and the parent might have 0 loans, and the subsidiary's loan, its book value is 100, but we paid 40 for it. In our investment account, we have a $40 debit. We know that at the end of the day, this number has got to be 0 here. So we're looking to do a credit, 40, to help get it over there. This is the investment account. All right, I know that's not, but this is the investment. Okay, we'll just call it INV. So we know, and let's just say this is the acquisition date consolidation balance sheet. So we'll just start with the acquisition date. So in this case, since we're going to have to credit the investment account by 40, means that the offsetting debit for the loan is here, bringing the loan balance down to 60. Why? Because with the terms that they had, we could have only borrowed 60 today. They have good terms. It's just the way it worked out. Interest rates went up. So the loan balance to the consolidation will reflect this, reflecting that we paid $40 for the loan, a premium of $40 for the terms of the loan. Now what do we do with this? We have a differential of 40. That's no different than the differential of the assets of the tangible property, the intangible property, which have definite lives to it. So we're going to have to, we can call it, we're going to amortize this over the life, the remaining life of the loan. And it'll look like this. Every year we have 40 as our total, and we're told, let's say we're told that the life is 8 years. So we're going to amortize 8 years of 40, which is 5 a year. The consolidated loan balance is lower than what it should be, compared to the book value. And so in order to bring the two the same at some point, remember this is the opening date balance sheet, acquisition date balance sheet, where the loan is at 60 compared to 100 on the books. So to reconcile the two over the life of this loan, we're going to every year we're going to credit, when we do our adjustments, we're going to credit the loan every year, so that after 8 years we have brought the $40,000 back as a credit to the loan to agree to the books. So if that's a credit, we need an offsetting debit, and that'll be to interest expense. For 5K. That's our adjustment every year, our amortization adjustment every year. Let's take a look at what it looks like on the consolidation. Here's our adjustments. And here's our consolidation over here. So the parent, let's say, when it comes to the loans, that's 0. This subsidiary has this 100. And let's do this as at the end of the first year. So at the end of the first year, we do our debit here, because the investment account here has 40 in it. So that'll do that, and that agrees. And then what we'll do is at the end of the year, we will credit the loan payable for 5 and debit interest expense for 5. So now our loan balance, when we come across to the consolidated, and by the way, this part here, make sure that the investment account on the consolidated work papers is 0. Now when we do our loan payable for the consolidated, here the number becomes 65K. At the end of the first year. Of course, that's not taking into account the fact that the subsidiary reduced their loan balance at the end of the year by what they paid towards the loans. So it's not exact what I'm showing you. It's just giving you an illustration of the entries. In actual fact, because the subsidiary is reducing their loan payable in their books, they will have reduced it by, let's say, 10. So it'll be 90. But it really should be, it should really be 65. And let's see, is that how it would work? I don't know if this will work out, but let's see. 90 minus 45 is 5, that's 55. So, does that work out right? Yeah, that does work out right, in a sense. It does work out. So the subsidiary on their books would have brought the loan balance down by, let's say, 10 to make the loan balance 90. But we have brought the loan balance down from where it was 60, now it should be 55. You don't have to necessarily worry about the loan balance if you just follow the concept of amortizing the differential over the remaining years correctly, and that's this part of the entry, just in case you're not following it. That's this part of the entry. Every year you do that. Of course, in a multiple year situation, you have to be cognizant of the fact that this is the opening year of acquisition, so the next year the number that you want to put in here is going to be 35. Let's do that. Let's show what that would look like. So this is year 2, parent, subsidiary, your adjustments, and the consolidation. So you've got the investment account, got the loan, and interest expense. So in this case, the investment account has come down in value, just through the normal terms, or going up in value, but whatever the equity method does, it doesn't matter. And here the loan continues to come down, so in year 2, at the end of year 2, it might be 80. And what we're going to do on our adjustments is we're going to do this, amortizing that interest expense, and we'll credit the loan. But we've got to bring the loan into the balance that it belongs at the beginning of the second year. This is second year. And that was, it started at 40, then we reduced it by 1 year of depreciation to 35. So here it would be 35. And then, of course, you carry it across as it's supposed to be. We'll come back and try it again the opposite way and see what happens.